Can the PNB MetLife goal ensuring multiplier plan truly amplify your wealth, or is it just another ULIP with flashy promises? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. This is an individual unit-linked non-participating life insurance plan. Some of the key features of the policy are you get to choose from 5 distinct plan variants tailored to your financial goals, and you can also opt to pay premiums for a limited period of 5, 7 or 10 years throughout the policy term or as a one-time payment under the wealth option. And you have access to 17 different fund options aligned with your risk appetite along with 3 predefined investment strategies, and you can also enjoy the return of fund management charges, mortality charges, premium allocation charges, and you get rewarded with additional benefits based on the premium amount and the policy duration, and you also have premium waiver benefit in case of critical illness or policyholder's death, ensures uninterrupted policy benefits, and you can also enhance your coverage by adding riders for additional protection, and you can also receive investment top-ups at specific milestones during the policy term to grow your corpus further as in the form of fund boosters. And now there are 5 plan options. So the 5 plan options are wealth, wealth plus care, goal assured, income assured and smart child option. And you also have benefits like death benefit, maturity benefit and also waiver of premium benefit. And as I have previously mentioned, there are 3 predefined strategies like self-managed strategy, systematic transfer strategy and life stage strategy. And there are 17 fund options, and in this tabular column all these fund options are categorized based on the percentage of allocation each fund option has to asset classes like equities, debt, money market, and also according to the fund options risk profile, the tabular column has categorized it from low to high to very high risk. So these are all the fund options, and there are also various charges that they impose on you as a policy holder. So what are those charges? There are mortality charges for providing you with life cover, and also morbidity charges which apply only in the wealth plus care plan option, and partial withdrawal charge, but under the smart withdrawal facility it is free of any charges, and they also give you premium allocation charge and policy administration charges and fund management charge for managing your funds, also discontinuance charge and switching charges. So the thing is, all these charges under this plan are significant for a market link product because this is for something that is present in a ULIP policy, but compared to other ULIP policies or other market link product, the charges are heavier in this policy. And also if you compare it with the other mutual market link product like a mutual fund for example, they do not give you charges like discontinuance charge, premium allocation charge or partial withdrawal charge. There are no charges like these. So what happens is these substantial fees will reduce the net premium invested, impacting your results. As a result, your final proceeds over the long term will be affected. So these are some of the drawbacks of this policy that you need to keep in your mind before deciding to invest in this policy. Now, if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Some of the advantages of investing in this policy is that you can choose to increase or decrease your sum assured, request a change in the premium paying term, and an option to reduce the installment premium after the first 5 policy years is completed. And you can also redirect your future premiums to different funds based on your changing investment preferences, and you can also move your investments partially or fully between available segregated funds under the self-managed strategy, and you can withdraw funds partially after completing the 5-year lock-in period or upon the life assured turning 18, whichever comes later. And with the wealth option, you can schedule your automatic withdrawals of 1 to 12% of your fund value at a frequency of your choice, and you can also boost your investments anytime during the policy term with additional top-up combinations. So now let us take a look at at the disadvantages of investing in this policy. So the disadvantages are there are no loan facility available in this plan, and this policy comes with a mandatory lock-in period of 5 years, and only the net premium, that too after deducting applicable charges, is invested in the chosen funds, which will significantly reduce your long-term returns. And also this policy especially gives you life insurance coverage, which is a limited coverage. Basically it means it is inadequate to meet the comprehensive protection needs your family might need in your absence. So the life coverage here is not sufficient. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where we are going to analyze the internal rate of return, calculate the IRR of this policy based on the benefit illustration given in the policy brochure, so that we can take an informed decision based on the returns we actually get in our hands at the end of the day. So for calculation purpose, let us assume a 40-year-old male opts for the GEM plan with a sum assured of 10 lakhs, a policy term of 20 years, and chooses to pay an annual premium of 1 lakh for the entire duration under the wealth option. And at maturity, he receives the fund value depending on market performance. So here, based on the benefit illustration given in the policy brochure, it assumes two possible rates of return, 4% and 8% per annum, to indicate the worst and best case scenario, because this policy does have market linked risk. So to show you and demonstrate both the extremes, they are calculating on these assumed rate of return. They are just for example purpose. They are not guaranteed returns. The actual returns will vary depending on various factors, including the policy's future investment performance. So at 4% annual return, the projected fund value is 26.60 lakhs, resulting in an IRR of just 2.65% as per the policy's maturity calculator, which is even lower than what most savings accounts offer. And at 8% annual return, the estimated fund value is 41.25 lakhs, translating to an IRR of 6.48% as per the policy's maturity calculator. While better, this return still appears modest given the equity market exposure and associated risk. So equity investments are typically expected to deliver alpha, that is, the returns that comfortably beat inflation over the long-term period. In comparison, the returns projected under this policy are more in line with debt instruments, not equities. So the GEM plan may not be suitable for investors looking to include aggressive equity exposure in their portfolios, as the risk-return trade-off does not appear to be favorable. So as this policy is not giving us the desirable outcome that we need, we are going to conduct a comparative analysis now, where instead of bundling up insurance and investment, we are going to invest in both the components separately to see whether it can perform efficiently in isolation. So here, for example purposes, we are going to take the same or similar metrics in the GEM plan in this scenario as well for a fair comparison. So we are going to consider a 20-year policy with a sum assured of 10 lakhs. So under the GEM plan, the policy holder pays 1 lakh premium annually, but here instead of choosing a bundled ULIP like GEM, for life cover purpose, we are going to purchase a pure term life insurance policy offering the same 10 lakh coverage for just 7,000 rupees premium per year. So this frees up 93,000 annually, which can then be invested according to the investor's risk profile. So if you are a conservative investor, you can choose a debt instrument like the Public Provident Fund (PPF). So here the maturity value after 20 years would be approximately 41.28 lakhs, generating an IRR of 6.49%. Remarkably, this is on par with the 8% return scenario projected under the GEM plan, despite PPF being a low-risk government-backed investment. On the other hand, if the 93,000 is invested annually in an equity-linked savings scheme, the potential for wealth creation increases significantly. Assuming average market returns, the ELSS investment could grow to 75.04 lakhs over 20 years. So after accounting for the long-term capital gains tax, the post-tax maturity amount would be 68.14 lakhs, resulting in an IRR of 10.64%. So this return comfortably outpaces inflation inflation and far exceeds the GEM plan's projected outcome. So if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column as ELSS tax calculation presented on the screen for your reference, which you can pause and see. So these comparisons makes it evident that separating insurance and investment is not only more cost effective but also more rewarding in terms of returns, liquidity, etc. So the split approach allows for flexibility, better returns and transparency, which are key elements often lacking in bundled products like ULIP. So what is the final verdict on PNB MetLife goal ensuring multiplier plan? Is investing in this policy worth it or not? So this is a policy which offers a variety of choices like 5 plan variants, 3 investment strategies and 17 fund options, allowing investors to tailor the plan to their preference. However, despite this apparent flexibility, the plan fails to deliver meaningful value in the long run due to its underwhelming return potential. The primary reason for the subpar returns lies in the high charges associated with the plan. While the policy promises to return some of these charges over time, it does not account for the time value of money, which significantly erodes the actual benefit. As a result, the overall growth of your investment is dampened, making it difficult to meet long-term financial goals and also has a high agent commission. So market-linked instruments are ideally meant to help investors build wealth over time. But the GEM plan does not meet this fundamental expectation. Moreover, the life cover provided on the plan is insufficient, leaving a crucial protection gap. So these two limitations, the low investment return and inadequate insurance coverage, makes this policy a poor fit for a long-term investment strategy. So in essence, while the GEM plan may offer market-linked exposure, it doesn't provide the level of returns that justify its structure and cost, especially when better performing alternatives are easily accessible. So if your goal is to build a strong equity portfolio, you need products that offer higher growth potential. So what would be a more effective approach? It would be to purchase a pure term policy that provides sufficient life cover and separately invest your money in instruments aligned with your risk profile, life goals and time horizon.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.